Hello, I'm Steve Foerster. Welcome to our project In Pursuit of the Perfect Portfolio. It's my pleasure to be here with Dr. Marty Leibowitz, author of the classic book Inside the Yield Book. He's also the 1995 inaugural inductee into the Fixed Income Analyst Society Hall of Fame. Marty, welcome.
Thank you. Thank you.
I want to take you back, Marty, to one of the first careers that you had before your investment career. You were actually in the carpet manufacturing business. Can you tell us a little bit about that, and what were some of the key lessons that you learned?
So I ended up doing all kinds of things, ranging from dealing with very nice and occasionally very irate clients, finding the proper site for a new manufacturing facility, negotiating for the land in a small town in Georgia, and also being involved in developing some material handling devices, designing a new warehouse, and actually have a couple of patents to my name on that as part of that project. So it was a very wide-ranging and very much of a learning experience.
And tell me about Sidney Homer, your wife's uncle, who was very instrumental. You had a close personal and professional relationship, and he really helped to shape your career. Can you tell us about that?
Sort of. These things are never quite as simple as they look. Sidney was a brilliant man. He went through Harvard in very short order as a young man, and then disappointed his artistic musical family by having to take a job on Wall Street, and he worked his way up to being really called by many the bard of the bond market.
At Salomon Brothers.
At Salomon Brothers. And he had written this fantastic history of interest rates. He did it really as an avocation, not knowing how important it would ultimately be. But that got him great respect among many participants in the bond market at that time, and eventually landed him at Salomon Brothers. Well, I had never heard of Salomon Brothers, and we had been going over to Sidney had an apartment on Gramercy Park, and we would go there for a number of family occasions. And he was a grand, sort of old school type of guy, very gracious but very austere in some ways. So after a number of years, he pulled out a manuscript because he heard that I was finishing up my doctorate in math, and he said, "Maybe you can help me with this." And he says, I was writing, I'm quoting him now, he was telling me he was writing a book on the mathematics of bonds, which he felt would be an important book. And he ran into one problem, that as he was describing what he thought was the way bonds behaved, turned out that the numbers didn't work out that way. And he was confused as to why that was the case. And no one that he talked to about bonds at that time seemed to be able to help him. So I got to confess, I never knew much about bonds. I never saw a bond yield that whether I liked it or not. And so I said, well, where do these bond yields come from? Okay. And he handed me this fat book of tables. And that really didn't help me much, but there was in this introduction a description of how bond yields were calculated. So I did what was now be called reverse engineering. Not too easy, but I got there and found out how these yields were calculated. And my initial reaction was, you've got to be kidding. Got to be kidding. This was done in a kind of self-reinforcing way, circular way, internal rate of return, really what we would call it these days. And so I pointed this out to him and said, this is not what necessarily has to be the source of return. It's not the sole source of return, and that it can be, under some circumstances, misleading. So I thought that was interesting. What was happening at the carpet company, meanwhile, was the sales were increasing at an incredible pace. We were being very, very successful. And I thought it was important to consider going public. So I thought I would go and ask Sidney. I knew he was on Wall Street. I didn't know anything about the firm, Salomon Brothers. I asked him if he would suggest someone we could talk to about what that would be. And he said, well, we don't do that sort of thing, but I'll see if I can get I'll talk to some of my partners. turned out that they had some interest in taking small new companies. Didn't have a presence there, but they wanted to get there. So he introduced me to a few of his partners, and then I found out that this was not just a bond house. This was a huge bond house. It was the hugest bond house, and that it was a real powerhouse. And so I said, well, gee, it'd be kind of nice to meet the house mathematician. And it turned out there was none. So then a little light went off in my head, and I said, well, I think you guys need a house mathematician, and I have a wonderful idea for you. And after about 15 different interviews, then I finally ended up with a job there, sitting on the trading floor with a little computer.
So this was in 1969, I think it was?
69, yes.
So what was that experience like then? And when we picture trading desks now, I'm sure it was much different.
Well, it was, the first time I went there, I said, okay, you've got to be kidding. There was a ticker tape going all around this huge room, and every once in a while the ticker tape would break, and people would panic and they'd run with Scotch tape to fix the ticker tape. And they'd be they didn't have the screens. They were screaming to one another, and they didn't have really many computers. They didn't even have calculators, and so they had these big tables they would go through, humming through, and trying to find out what the price would be for a given yield and what the yield would be for a given price.
These are the yield book.
The yield book. Not many people know what the yield book is anymore, but I did eventually, after I went through a whole lot of interviews, because they were not convinced they needed a house mathematician. But I finally found, I think, it wasn't Sidney actually. It was other people that I met there who basically promoted the idea that I could be of use to the firm. One person who eventually ended up working for a very nice man called Harry Peterson was instrumental, and a couple of others. But in any case, so I basically, with help, talked my way into this job. And then working with the computer, I harked back to the discussions I'd had with Sidney, and decided now that I had the computer, I'd try to work up a little spreadsheet to more firmly demonstrate, or more clearly demonstrate, why that yield to maturity calculation, which was standard, was flawed in terms of various important applications, namely in terms of the vulnerability to the reinvestment rate.
So this was going to lead to one of the first of a number of memoranda to portfolio managers.
Yeah, so I showed this, I started showing this output to various people around the floor, and I was met with incredulity. Said, no, the yield was so embedded in their thinking and the way they looked at things that they couldn't conceive that there was anything wrong with it, or that what I had shown was, or what I was trying to show was correct. But it was pretty incontroversial, go year by year and you see what's happening. When
so you were focusing on the reinvestment rate and interest on interest, which was your first memo.
So then I went, I showed it to Sidney, and he said, interesting. And to his credit, Sidney was, he was sort of old school, but he was open to new ideas. So fast forward to actually several weeks, and I'm down there in Florida visiting my mother, and I get a phone call from Sidney saying, I think we should write a little memorandum. And so that was it. We wrote the first memorandum, interest on interest, and that got quite a nice reception in the community, and it had importance. Had importance in terms of, which I'll describe in just a second if you have the patience. It had importance in terms of, at that point, yields had been rising for many years. And so one thing that happened was that just about all bond portfolios were selling at a discount, deep discount, and underwater. And the firm was having trouble getting insurance companies and pension funds to consider trading those locked up, because they have to take losses, and they felt that they would not be able to recover those losses. And they had various formulas for ascertaining whether various incorrect formulas for ascertaining whether they would recover those losses. And so there's a huge amount of the outstanding bonds that were just locked up for artificial reasons. So it turned out that when you start looking at these calculations in terms of the proper accounting for reinvestment rates, that many of these losses could indeed be recovered. And that made an argument for unlocking some of those portfolios. And aside from hopefully doing some good, that also enamored me to the senior partnership of the firm, which was happy to see this transpire. So that led to the further chapters of Inside the Yield Book. That was, and then it was, by that time we were kind of on the road. The other thing that happened, and it was, again, these are kind of parallel moves, is the yield book, big fat yield book, went up to 6% yields. Didn't go above that. So when yields got above 6%, all these senior traders panicked because they didn't know what to do. It just so happens, again, good luck, I had the one computer on the trading floor which could calculate yields for prices and prices for yields. And so I had these traders, and you have to understand, back then, a trading firm like Salomon, the senior management of the firm, they were all traders. They were all on the floor at the time. Because no one was sitting in offices off to the side. That was not done. Everyone was actually active. All the big shots were actively involved. So all the big shots basically had to come to me to get their prices and yields. And they ended up forming a line behind my desk. And it was kind of harrowing because they were not patient. But anyhow, that sort of helped to get me deeply involved with the actual process.
Fast forwarding to the 1980s, you and some colleagues made a big contribution in this area that became known as asset liability management and liability-driven investments. What was your contribution there, and what were some of the big revelations?
Well, first of all, I think that asset liability management as an idea had been around for a long time. Okay, so I certainly don't get credit for having invented that by a long shot. What we were fascinated by the pension fund problem, and we noted that I guess the key observation was we were looking at how returns from various types of portfolios would behave, and then we looked at the liability and saw that if you mark to market the liabilities, which was again just starting to come into fashionability, or almost more than fashionability. There were some accounting changes were leading to it being required. That you could almost look at the liabilities as a negative bond. In fact, you could look at it exactly as a negative bond. So you had returns from the assets on the one hand and returns from the bonds on the other hand. And the question is to what extent do you want these to be in sync, or can you allow them to be out of sync so that you have discrepancies between what your needs are and what your assets are providing. So that really led to a series of articles, one of which was called Liability Returns. And then we put that together with the asset returns and with the total portfolio concept, which would be the net value of the. But this has been the realm of actuaries who have struggled with this for years.
I want to fast forward to your time at Morgan Stanley and some research that you did. One of your research papers that probably got the most attention and certainly had the most colorful title was one that you called Alpha Hunters and Beta Grazers. Can you talk about that paper and the impact it had?
Yes. This was what kicked this off was the Financial Analyst Journal was celebrating its 60th anniversary. And the editor of the Financial Journal at that time was Rob Arnott, who you know, and a very good friend of mine who worked for me for a period of time, which is another interesting story, which we'll save to see if we have time for the next book. Okay, but Rob asked me, along with a lot of other people, if we would produce a contribution, and your friend Harry Markowitz and all the other usual suspects were, I think Charlie also were invited to do the same. The guidelines that Rob set forth were, this is going to be a volume, and it's going to be for general interest. It's not going to be mathematical. It should have no mathematics in it. It should have no graphs in it. It should have no tables in it.
That's pretty restrictive for many people.
Well, for me, I had never written a paper that had no mathematics in it, no graphs, and no tables. So I found that very, very hard to do. I struggled with it. And then when I finally got something put together, and it was really, really arduous, I tried to think of a good title. And I tried about 20 different titles, and finally came out, it was one of these bingo moments, Alpha Hunters and Beta Grazers. And the title carried the day. I don't know if people actually read the paper, but they saw the title, they liked the title. Sidebar. When we got the book, I happened to open the book, and there was a chapter by Harry Markowitz. And Harry Markowitz's paper was full of mathematics, had lots of graphs, and lots of tables. And it was a great article. That's not too surprising.
So what are alpha hunters? Let's start there, and what are beta grazers?
The idea was that we've been working on the idea of beta this was actually well before this became the smart beta kind of stuff. Beta as being kind of a passive sort of approach to structuring a portfolio, getting its main risks, which essentially were equity type risks, and having the beta basically go on as an asset allocation, which one would, to a large extent, maintain over time. Okay. Now there's a lot more to that story, but that's sort of the general idea, and that the alpha hunters would be, and we're talking about seeking mispricing opportunities to buy cheap, sell high, or buy cheap, sell normal. And the idea that was construed as an alpha on top of this, what you could obtain cheaply and relatively easily in terms of this beta grazing. But it was hunting. It was the carnivore versus the omnivore, versus the herbivore, rather. And the idea that would be viewed as a different kind of lifestyle, a different kind of culture, a different kind of risk-taking, was what really sort of motivated that article.
Did it cause a lot of investors to think about and reflect on whether they were alpha hunters or beta grazers?
Everyone saw themselves. Everyone viewed themselves as a prudent omnivore. But the title did catch a lot of attention. I got a lot of. In fact, Rob Arnott, when I sent it in to him for approval, he said, everyone should be required to read this article. And I argued with him vehemently. Not. So anyhow, but that was so painful to have to write under those constraints for me. Okay, it was just, and then Harry, just being Harry, he had the freedom to do what he wanted, and it turned out great in its own right.
So being unconstrained, then you teamed up with a longtime co-author, Anthony Bova, as well as Brett Hammond.
Right. And
you came up with the Endowment Model of Investing, which was a very impactful book. I just want to read you the setup of what you say, and then you can tell us some more about the contributions.
Take your time.
You talk about this model adopting a new approach to describing the risk and return characteristics of individual asset classes, and then exploring how this reformulation affects their role within a total portfolio. So you really were turning things on its head. Can you talk about what this endowment model is all about?
Well, I think turning things on their head is a little overstating it, because I would say that we really tilted things a little bit in a direction they were going to go anyhow. Okay, I think appropriate modesty is. I mean, people had been doing, from going back to Harry Markowitz and Bill Sharp's work and Jack Trainer's work, the idea of taking a covariance matrix and using it to assess the volatility risk of a portfolio was, dates back to like Harry's work was 52. Yeah.
Yes.
So it was not exactly novel, but that was more, well, there were a couple of things. That was more in the context of usually in equity portfolios. But it had been starting to be used in asset allocation as well. But I think what was novel, I mean, now at the same time, people knew that most portfolios that they were configured, the 60-40 portfolio, which was
60% equity and
40% bonds,
fixed income.
but that was at the institutional, that was migrating into portfolios that had equities, bonds, international equities, emerging market equities, real estate, sometimes commodities, mortgages, commercial, private equity. So there is a lot of alternative asset classes are getting into this portfolio. And people recognize that the majority of the risk, certainly the short-term volatility risk of this portfolio, was derived from the relationship to equities. But we found it very, very helpful to take and say, okay, look, if you have a covariance matrix, you can form a beta for each one of these assets. And that beta relative to equities shows the sensitivity of how that return of that asset class will move relative to equities. And if equities is indeed the overriding source of volatility, which it is, then all you need is the beta. Okay? It was kind of the analog of what Bill Sharp did for equities alone, in terms of the capital market line and all that kind of stuff. That great stuff. But it had I think, a impact in the sense of saying, okay, I could say that if you have a portfolio, I can look at the betas of the asset classes, come up with the average weight of them, and I can tell you what the volatility of your portfolio is. And now that was kind of striking. And many, and not only can I tell you what the volatility of your portfolio, what the beta sensitivity is, I can tell you what the volatility. I can say that, for example, on an ex ante basis, a priori basis, your portfolio would have a volatility of 10%. And moreover, it turned out that just about all portfolios that you see in practice, institutional portfolios, had betas of between 0.55 and 0.6, which corresponds to, going forward, volatilities of 10%.
So even though they deviated from the 60-40.
Even they totally looked different. They looked totally different. Some had no private equity, some had hedge funds in them, lots of hedge funds, some of them had all equity, and they all looked roughly the same. It was just and that was shocking to people. Individuals knew what their portfolio volatility would be. They had gone through this covariance analysis, but they didn't know that the beta A determined it largely, overwhelmingly, and B, that everyone else had the same volatility risk. So that was, I think, the thing that really kicked this thing off. Then 2008 came along, and we found out that these covariance matrices really got blown up under stress conditions. And so we had to come up with the idea of stress betas. And you could say that, well, some asset classes, like private equity, have a high stress beta in terms of the mark to the market, or in terms of the liquidity needs, whereas other asset classes like direct equity have much less. I mean, their beta is what it is. It's a stable beta. So that turned out to be, I think, a very fruitful way of thinking about things.
So really a different way of thinking about things and looking at betas in a whole different manner.
Yeah. I mean, I had fun with a number of institutions. They were going through this very, very complex portfolio optimization, and ended up with and they were talking about how they had volatility estimate, I would say, I'd look at their portfolio and I'd say, I know what it is. I said, well, we witnessed this huge calculation I'm about to tell you. I said 10%. So, yes.
So we've now come to the main question for you, and that's this topic of the perfect portfolio. What are your views on the perfect portfolio? It might be a moving target. It might differ from individuals to individuals, but how should we look at and strive for this perfect portfolio? What would it be for you?
Well, let me describe some of the things that go into it, okay? First of all, it's important to know how much risk you can take. And I think that's something which is easily said and not well appreciated. Many institutional investors view themselves as being very long-term oriented. And yet, if you see how they fared during 2008, or even under lesser pressure points, you find that their long-termism can come apart under pressure points.
So we can claim to be long-term, but in reality we may not be?
Well, you know, I tried to point you to that one particular table showing the waterfall of how people go from being convinced that they're long-term to being less sure, and eventually then getting to the point of panicking, okay? So I think that's of course a well-known danger, and the issue is what you do about it, and it's the usual standard answer is stay the course, which is usually the right answer, but not always. Not always. Aside from the emotional reaction of wanting to de-risk at the wrong time, or de-risk in the face of bad times, there is a consideration, especially more for individuals, but not just for individuals, where you get to a point where the risk level in the market relative to your portfolio and your ability to take risk may essentially move you to say, don't stay the course. Cut back some, okay? Sleep better at nights, or if you're sleeping at nights and you shouldn't be, get yourself to the point where you should be sleeping better at nights.
So not necessarily buy and hold is what I hear you saying.
Definitely not buy and hold, okay? Even though buy and hold may be a good advice for openers, it's not a good advice for ending, okay, or for getting through the process. So that's one aspect of it. The work I did on funding ratios was helpful in terms of, this is for pension funds, but it's useful to, I think, generalize that concept, to think about a kind of generalized funding ratio, which I would define as being how much of you have in terms of assets, in terms of assured future income, relative to your needs. And that's high. You have a high funding ratio. You're in a comfortable position. You can afford to take risks. You can afford to take risks.
Would that then translate to take more equity proportionately, for example?
Well, it would. You could do that, or you could take more equity-like risk in terms of alternatives such as private equity or venture cap. Nothing in investments is absolute. So having the ability to take more risk doesn't necessarily mean that you should. And there are a couple of conditions under which you maybe shouldn't, even if you have the ability. First of all, suppose the market is riskier or more expensive, and the reward to risk is, you judge it to be really, and you can't do this kind of on slight variations, but are sufficiently far off what should be a reasonable mark of risk reward. It may be that even though you could take more risk given this generalized funding ratio, maybe you shouldn't. Even though you may be able to take more risk, the risk reward may not be sufficient to justify that. Those are all never easy decisions, but I think ones which, if you're an investor, you really have to be prepared to try to make those judgments, not continuously and not for just small things, but when things become sufficiently, where the prospects are sufficiently out of line, Okay, it doesn't happen very often.
But 2008 would be a good example.
Well, yeah, actually, and 87 would be good, where things are discernibly out of line. Another condition under which you could be in a position to take more risks, but may elect not to, is where you don't have to. Think of a situation where an individual has a modest lifestyle, has no heirs, is not particularly needful of any grants they want to give to charitable grants. He's got things where he wants them. Why should he take more risk? Risk will not give him more return. Incremental return will not have a marginal value to him. So a situation like that, you could actually go to ground. Now, this also happens institutionally. I mean, people don't really think of it this way. Many corporate pension funds, for example, as they get towards being fully funded, will basically, as they hopefully get to fully funded, will basically take their risk down and immunize the portfolio. Say they got enough to take care of their liabilities. I'm not in the game for fun, and actually there's less benefit to going and having higher than 120%, say, funding ratio. So why do it? Okay, so that's and in the other direction, many, for example, or a number of state funds in Europe, especially in Scandinavia, will only allow you to take higher risks if you have a sufficient. So it goes both ways, and who's to say what's right? These are not things where you can say one thing is right or other thing's wrong. There's one other aspect to this discussion which I should throw into the pot, which you see, and that is, as the inverse of this would say that as your generalized funding ratio becomes lower and lower, you should take less risk. Like maybe some pension funds we can think about, but they opt to take more risk because they feel they don't have a choice. And that's, one can argue about whether that's right or not. There's certainly a reasonable argument to be made in that direction. But so these things are far from absolute, but I think nonetheless it enriches your discussion, your thinking about things, to have these types of considerations in mind.
And for an individual, you talked about the weights might change. What about the composition of that portfolio? Diversified, I presume?
Well, the thing is, absolutely. The one thing you don't want to do is take unintended risks. And to the extent you don't diversify, you are taking unintended, unrewarded risks. Okay, so you want to get to take the risk level that you want to take. You want to have it be a risk level which basically is determined by a beta sensitivity, rather than just having. Now, the other thing is that beta sensitivity, the equity risk is far more volatile than, say, fixed income risk. So that's why it is the dominant factor in almost all portfolios. So yes, you certainly to hold one stock is nuts, unless you happen to pick. As Will Rogers says, I have a very simple philosophy. Remember that? Only buy stocks if they go up. If they don't go up, I don't buy them. So it would be nice if you have that kind of retrospective. So, but not being able to do that, one should have diversification, as Harry Markowitz so beautifully pointed out, is the cheapest source of reward. I mean, because it's not just reducing risk, but when you reduce risk, when you reduce unintentional, unrewarded, artificial risk, you can then take and amp up your risk to the point where you get a reward for it, and therefore you can get the right kind of reward that you're seeking.
So diversification within asset classes and across asset classes.
Right.
So starting with some kind of risk target and then forming a portfolio to meet that risk target?
Yeah. Now, what actually happens in the real world, as we say, okay, is that, and when people go through portfolio optimizations, they'll go through all kinds of covariance matrix, all this kind of stuff. And they'll find that they'll get, depending on their inputs, there's a huge sensitivity to the inputs, that's well known. They'll come out with, like a few years ago was, before we found out to the contrary so vividly, was thought that real estate had a very low correlation to equities, okay? And so you put that low correlation in there, and the portfolio optimization, unconstrained, would blow up the real estate portion to 40% of the portfolio. And so a typical asset owner would look at this and say, well, no one else says 40%. I can't tolerate, I don't even have the, one of the things which this brings up is you should focus on those asset classes, give them an extra tilt where you have some structural advantage in being able to ascertain whether they are well priced or what their prospective returns will be. Stanford has a great structural advantage in terms of tech, okay, as MIT does. Other places have structural advantages in terms of geography and so forth. Take advantage of those structural advantages. That's just common sense, which is all too rarely recognized. Okay, so going back to real estate, which is where I took off, okay? You got 40% real estate, you see this in your portfolio, you say, I can't tolerate that for various reasons. Maybe I don't know how to do it, but maybe no one else has it, but whatever it is, my board's not going to tolerate that. So they chop it down to 12% or 15%, okay? No matter what it says. Now, if you look at how portfolios are formed, you find there's so much commonality in these portfolios. This is why they all have this beta of 0.55 to 0.6. It's because they really, this whole process of putting things into an acceptable shape drives it towards that basically common volatility result.
Any last comments in terms of what we should be considering in our perfect portfolios, or as we strive for those perfect portfolios?
First, know what risk you can really take. Second, try to set up contingency plans so that you can actually afford to take those risks and have a course of action if the risks actually eventuate. Because when you're talking about risks that you can take, you're talking about things that might happen. And you want to the extent that you are prepared to deal with them when they happen, painful as that may be. One of the things we found from 2008 is that most people's responses were dysfunctional. They were not helpful. They either froze the portfolios, which was not uncommon. They certainly did not rebalance. Some rebalanced mechanically and too early and got creamed, okay? Others actually sold their equities at the wrong time. And others did it because they found themselves in great liquidity squeezes, which were, in retrospect at least, predictable. And now I think, given what we learned, probably in prospect predictable. So you should have a plan for liquidity needs in the face of deep trouble, of increasing trouble. You should have a plan for how you're going to rebalance or not, or over rebalance, and I point you to that one aspect. I think that kind of, now how do you get a contingency plan? Well, institutionally, the thing is to have a plan worked out that makes sense and is approved in advance by the board. Now you put it, it's like a warplane. You put it like a military has a warplane on it, they have a battle plan on the shelf for a whole bunch of scenarios. And as they start to transpire, you pull it out. Not that you're going to follow it slavishly.
At least it gives you.
But if you something which said, okay, under a point when we could have cool heads, this is what we thought we should do. And we may want to change that, but at least that's what we all agreed upon before. And at least it gives you the, otherwise, emotions, panic, all kinds of bad behaviors will lead to bad results. And I think we learned that lesson from 2008 and other instances in the past. And that also applies to having a liquidity waterfall, so you know that you can have as the needed. The one thing you can't run out of is liquidity. Okay, it's like, you know, how do you make a country work? You feed people. If you don't do that, you got trouble. Okay, if you don't have liquidity, you have trouble in a portfolio. So you've got to, I think about those things, and I think individuals can also try to move in that direction, to think about what would they do, and you know. We were talking earlier, there may be a time where if they're sufficiently amply funded and things start to go sour, they may decide to sort of take something off the table. Okay, but they should make that decision not in the heat of battle, but in the coolness of thinking about what their real needs are.
Plan in advance. Yeah, yeah. Well, Marty, I really want to thank you for sharing your insights and for all the contributions you've made over the years as the most prolific contributor to both Financial Analyst Journal and Journal of Portfolio Management. You have a lot to offer in terms of our pursuit of the perfect portfolio.
It's a sign of a wasted middle age.
I don't think so. Thanks again for
Okay, Steve,
for
you're a great interviewer.
Thanks.